Hello and welcome once again, Maverick Traders. This is our How to Trade Junk Bonds on the Interactive Brokers Trader Workstation platform. Interactive Brokers has a few different platforms. You can use their web portal, you can use a variety of different things, but TWS is their professional software, and we're going to dive into junk bonds and learn more about junk bonds, how to find them, how to do the analysis of what your risk and reward and probabilities and all those sorts of things are. So let's have a lot of fun and let's get right to it. All right, so first, what is a junk bond? Well, corporations prefer that they be called high-yield corporate bonds, and the reason they like that is it sounds better than junk, right? So a high-yielding bond is one that basically is higher risk, right? That's the trade-off. That's the teeter-totter effect. If we have more risk, we can have more reward, and that's the way it works in the bond market. And it's credit worthiness. If you think about an individual that goes to take out a loan from a bank, they're going to check that consumer's credit worthiness. Well, do you pay your bills? What's your history? How many assets do you have? How many of those assets are liquid? And so forth. And they're going to put a rating on you. They do the same thing in the bond market, and these are low rated, so they have to yield more money. And so a company that has to yield more is considered a higher risk. Now, that doesn't mean they won't pay off the bond. It just means it's a higher level of risk, so they'll pay you more interest. These are high yielding and aka junk bonds, right? So the reason I came into HYG, or you could use JNK the same way, these are ETFs that track the junk bond market or high yield corporate bond market. HYG is the symbol, or JNK is the symbol. Again, JNK stands for junk, right? High yield corporate bond ETF. If I go into the holdings, so this one, HYG, is made by iShares. If I go into the holdings, they'll actually tell me which corporations are in this and what weighting it is in the ETF. So for example, Ford has some bonds that are 2.29% of that ETF. Tenet Health, 1.5%. Occidental Petroleum, 1%. Dish, 1%. Teva, just shy of 1%, and so on. So these are all companies that at a certain point in time have sold bonds that were less than stellar credit rating. Now, that doesn't mean, again, that they're going to default. There's different levels. There's different shades of how dangerous you are. A company like Occidental might have been very risky a year or so ago. Oil, remember, went negative temporarily. Oil prices and oil futures went to negative 30 a barrel. That means companies that were selling oil were just basically losing money. That we're pulling oil out of the ground, and it costs us money, and then we can't sell it for anything. So it was a very dangerous time for energy. And then, of course, fast forward a year or two later, and oil has boomed back up, and Occidental has made billions of dollars of profit this year. So they were very dangerous when this was junk rating. But my guess is that I wouldn't feel that risky being an Occidental anymore, because if I look at the underlying fundamentals, so let's go to something like Google Finance, and if we just look at Oxy's fundamentals here, watch this. So here's Occidental Petroleum. Here are the fundamentals. If I look at the quarterlies, look at the revenue and look at the earnings. Look at the revenue and earnings. You see how stellar that is. Look at the annual numbers. And this might not look that bad, but remember, here was COVID. Here was 2021 and 2022. We're already in 2023. They'll post this annual number because sometimes their corporate year is not the calendar year, right? So after January and they report, they'll actually have the 2022 numbers. But look at what they're on pace for. If we just add it up, 9 billion plus 10 billion plus 8 billion, so that's about, let's call it 10. That's about 28 billion, and that's in 3 quarters. They do another 12 or so. They're at 40 billion on the annual number. The year prior, they did 25. So they're going to be 35, 40 billion on revenue. Look at their earnings. Last year, they made 2.32 billion in profit. This year, or last year really, but this past year, They made $4 billion in profit, almost $5 billion, 4.88. So let's round that to 5. $5 billion in profit in March, almost 4 there, and about 3 there. So 5, 4, 3. You've got 12 billion of profit, and that's missing 1/4. Let's say they're at least 15 billion. I mean, they were at 2 billion in profit in 2021. They're going to be 15, 16, 17 billion in profit, just in profit in 2022. So they were junk status previously. This is a bond that this ETF has already purchased. That's 1% of the holdings. Well, that was a great purchase because Oxy can pay off their bills. Oil prices have rebounded. This company is printing money. They can certainly pay their bills. And so that is a great purchase. And that's what you want out of buying a junk bond. You want to buy it essentially when it's distressed, but you see the silver lining. You see the path to profitability. You see that the company's going to be able to make it through. If the company does not make it through and they default on their bonds, not only is that a huge black mark for the company, but it's a very bad thing for you investor. As an investor, the first thing you want when you buy a bond is to make sure that your bond investment is going to be paid back to you at maturity. That's the first thing you want to make sure of. Secondly, we want to get as much yield as possible, but that's secondary. We don't invest for the yield. We make sure we're going to get our money back. And so we do some homework on the business, and we want to see that this type of scenario is going to happen, that the company, although it's in a period of distress, it's going to be fine down the road. So if we come over here and look, let's use Oxy as an example. This is on the TWS Trader Workstation. If I punch in Oxy, you'll notice it has stock, it has options, it has warrants, and so on. But I'm going to come down here to its bonds. Occidental Petroleum Corp. Click on its bonds. Whoops, it pulled it on the other screen. Let me pull that over. Let's look at the issue date in 2020 because we know that's when things were rough. And you'll notice this is when they were at junk status. They had to pay. So just compare and contrast. In 2016, they had to pay 2, 3, 4-ish% interest on the money they were borrowing. In 2020, after COVID hit and energy prices collapsed, they had to pay 8 to 8.5, almost 9%. It's a very different scenario. The credit worthiness of Oxy between 2016 and 2020 changed dramatically. This company had just purchased Anadarko Petroleum. They had bought out all those shares. They had taken on their debt. They had done a lot of things. But notice in 2020, they had to pay 8%, almost 9% on their debt. That's when they were at junk status. Now let's fast forward. They sold some in 2021 and it had already come down to 6%. So you can see that some of the relief had already come out of the market. This is the trend that you're kind of looking for, where rates were really high and then they start to come down on future debt. That's what we want to see, in essence, that we stepped in when we were collecting a nice amount of interest and then the trend became much lower. And even though rates have gone up substantially through 2022 into 2023, I would bet that if Oxy was to sell some debt right now, they'd probably still be below this crisis area, even though rates have changed dramatically. We've gone from the Federal Reserve, its Fed funds rate has gone from basically 0% to 4.5% through 2022. It's the most historic rate rise in history. And yet they would probably still be able to sell some debt for lower than that amount. Now, if you were to look at some of these, some of them are tradable, and that means that you can trade them. You can buy and sell them in the secondary market. The primary market is you get in on the issuance, right? When it was first issued on 7/13/2020. So in July 13th of 2020 is when you would have got in first on the issuance. But after that, you can buy and sell these in the secondary market. And you can see that these are yielding 8.5% until July 15th, 2027. But we have to pay more than face value for them. This is going to cost us 110. A bond at fair value, at face value, is basically worth 100. That means that if you put, usually bonds are maybe $1,000, $2,000, but let's say you put $2,000 into this bond, and you bought it when it was at 100. Okay, you spent 2,000. In this case, you're spending 10% more. So these bonds, if you were to buy them, you would basically be paying $2,200 for something that on July 15th, 2027 is only going to pay you back $2,000. So you're actually losing $200. It's minus $200 basically. Let's put a minus there. Minus $200 at the purchase. That's where you're at. You're buying something that's only worth $2,000 and you're spending $2,200 for it at current prices. But why might that make sense? Even though you're losing the $200 there, you're going to collect 8.5% from now through July 15th, 2027. And if we feel confident that they're going to be able to make that payment, well, on $2,000 invested, 8.5% is $170 a year. So they're basically going to pay you that for about 4.5 more years. So you're going to get about 4.5 more payments of that. You're going to collect $765 in income. Now you are going to lose that $200 investment, but you're going to make basically $565 on your $2,000 invested over the next 4.5 years, right? That's kind of where you're at in this particular position. Had you bought it when it first came out, you'd be making 8.5%, and when it hits maturity, you'd get your full 2,000 back, assuming Oxy does not default on that debt. So this is one way that you can find different corporations. You can do some different homework. You can kind of be aware of what's happening. Companies that are in distress, that are going through periods of kind of a downturn, well, they may be at a point where they're at a high yield kind of junk bond status. We need to do the homework and say, okay, is this a corporation that's going to be able to make it through and so on. We want something that might be struggling for a period of time, but that certainly we feel confident is going to come up and out of that. If you don't think that there's a path to them coming out of that okay, then your money's at risk. And you can see, I mean, it just isn't worth it. It's not worth collecting $600, $700 and then losing the $2,000 when it comes time for maturity. It just won't make up the difference. Now, let's think about some other names. So this is certainly not a suggestion that you should invest in this, but let's take a corporation like MicroStrategy. This is a corporation that's playing a very dangerous game. This particular corporation is investing in Bitcoin. Rather than holding cash, they're holding Bitcoin. Now, if you're big in the crypto space and you believe that Bitcoin is the future, as they do, and Michael Saylor does, well, have at it, right? You think there's upside. This is a very, very dangerous situation. And look at these bonds. So if we say, okay, let's go look at some of their bonds. Here's one that's tradable. We'll add that in. This is one that pays 6.125% from now through June 15th of 2028. So you've got about 5.5 years left in this one. Notice it's trading at a huge discount. What does that mean? Well, we could buy this bond essentially at 80 cents on the dollar, right? So in other words, if it normally would cost $2,000, we're only spending $800. If we could buy this bond at 80 as the price, we're spending $1,600 in essence to buy this bond instead of $2,000, which it would normally cost, right? If this was a $100,000 cost bond, most of them are two grand. But if this cost $1,000 and it was priced at 80, well, then we'd be paying $800 for a bond that at maturity is worth 1,000. Here we're buying a $2,000 bond that we only have to spend $1,600 for. And if MicroStrategy does pay their debts and pays off this bond in June 15th, 2028, we get the $400 profit. So we need to calculate the discounted rate that we're paying just the same way that we had to calculate the overpayment, right? We had to pay more for this bond than what it would be worth at maturity. We get to pay less for this one. So we can make the 400 there. Plus we make on our 2,000, we make 6.125%. So we make about $122.50 per year on this bond. Okay, you're going to do that for about 5.5 years. So we're going to make about $673.75 plus the 400 discount. So if MicroStrategy is able to pay their debts and this bond does not default and so on, and this is a big question mark, by the way, in my mind, but we would make a great return. We would end up making over $1,000 on our $2,000 investment. That's a great return in the bond market, because remember, bonds are safety, they're security, they're fixed income. They're not as big a risk, as big a reward. They're higher on the chain as far as if a company defaults, bonds might get a little something. Equity, stocks are wiped out in a bankruptcy, but bonds might get, they may not get paid off, but they might get 20 cents on the dollar or something. So here, assuming this company can make it through, we'd make over $1,000 on our $2,000 investment. When you kind of think about that, that's 53% divided by 5.5 years. You're making just about 10% per year, 9.7, 9.8% per year. So obviously, you're making a lot more than the 6.125 because you get to buy it at the steep discount. That's factored into your overall rate of return. Just like in this Oxy trade, we're not making 8.5 because we have to pay more than what the bond is worth at maturity. So we got to back out that overpayment into our total return. This isn't an 8.5. This ends up being, a 6% return or whatnot. This one ends up being a 10% return. Now, I'll tell you my opinion. This one seems pretty darn safe to me. This one seems pretty darn risky. Oxy has some additional backstops, in fact. Berkshire Hathaway, Warren Buffett, has been buying large amounts of this stock. It's entirely possible that Berkshire will buy out the entire corporation, and Berkshire has hundreds of billions in cash, which means they have plenty to pay off the debts and so on, which they would have to do if they bought out the corporation. MicroStrategy is playing a very dangerous game with Bitcoin. If Bitcoin collapses, they will very likely default on this debt. You'll never get that payment back, and your hopes for 10% return become just completely collapse, right? You end up losing 20%, 40%, 80%, whatever it is, when it's all said and done of your investment. So instead of looking at positive returns, if either of these corporations default, you're going to end up at negative returns. The question is, how bad is it? How bad did it become? So there's different shades of profit potential in bonds, just like there are in stocks. There's safer investments where your overall yield is lower, but you can feel a measure of confidence. There are higher risk, and there's higher risk investments than this one, but that's just an example of your total return could be pretty solid in that bond. If you are a believer in the Bitcoin world and you believe that it's going to boom over the next 5 years and so on, that should be very good for this corporation and very good for these bonds. Now, finally, you can trade in and out of these bonds. It's entirely possible. Of course, prices are moving, and this is a secondary market where these trade, right? That's part of the nice thing about having them tradable as well. If we want to get out, we can do so. Let's imagine a scenario where we buy this $2,000 bond at 80, and we were able to get this in our account or something. Now, frankly, I probably wouldn't buy this one. Let me come up here. We buy this one at 110. Okay, something like that. Let's make it simple math. So we buy this $2,000 bond. That's its face value, right? But we're paying more than $2,000. We're paying $2,200 for it. Let's say we buy this bond and then things go really well. You know, maybe Berkshire steps in and buys out the company, whatever. This bond will go up in value. So the price will climb from 110 to 115 to 120 to 125, and that can happen early. And so you might be sitting here, right now it's January 2023, and you say, okay, I paid $2,200 for this bond. I bought it at 110. I can get out a year later, let's say, at 130 or something like that. And you might decide to do that. You say, you know what? I paid $2,200 for this. I can get out hypothetically at $2,500, we'll say. So I'm up $300 on just the bond increasing in value. That happens, right? The bond can go up in value as yields go down, maybe interest rates in the market go down, etc. So I can cash out a capital gain. I can sell my bond that I paid $2,200 for $2,500, plus I collected 8.5% for a year. So I collected for all of the payments, 4 quarters, 1 full year. I collected the 8.5, right? I collected the 8.5. $170 plus I have the $300 in capital gain. Now this is probably too rosy of a picture, but we might be up $470 in owning this bond. And I paid $2,000 for it. I'm up 23.5% in 1 year on this bond, and I cash out. I sell it on to somebody else. And so it's entirely possible that your bond, you don't have to hold to maturity. You can trade in and out of these just like you would a stock or anything else. Now, the price doesn't always work out so rosy, right? It's entirely possible we buy this bond, interest rates go higher, this bond starts losing value. Now, we don't have to sell it, but if we decide to, we say, well, I paid $2,200 for it. It's only worth $2,000, but I think it makes sense to exit. I collected $170 in income for the year. I take a $30 loss and I decide to move on to greener pastures or something. That could happen as well, right? So it's tradable. If you buy this corporation when it's distressed and then Bitcoin booms for a year, hey, this bond is going to look rosy again. So it doesn't have to be held until maturity. It could be traded in and out of, and you want to pick your spots and be very careful about getting in, getting out, that decision-making process. But let me kind of go back to where we started. The underlying fundamentals of the business are important. If I look at MicroStrategy and I say, well, what's happening here? They've lost money on their Bitcoin purchases. And you see a very different picture here, don't you? What do you see here? Well, huge losses all throughout. Look at the last 5 quarters. They lost 27 million. They lost $1 billion. They lost 130 million. They lost 90 million. They lost 36 million. Look at the annualized numbers, huge losses. Now, they have revenue of 510 million, they have losses of 535 million. How do they have such big losses? Because they own Bitcoin, and Bitcoin has gone down dramatically. The opposite math could be true. If Bitcoin were to surge back up to 80,000, 100,000, $120,000 a coin, well, all of a sudden the profitability that they're showing on their income statement would be sky high because they have to mark this to market. So very dangerous game they're playing. You can see it's certainly not working out. They are down big on their Bitcoin purchases. So if nothing else, they've poorly timed it, and it might be an utter disaster for shareholders, for bondholders, for everyone else. So time will tell how this plays out, but that's a little bit about different angles of different corporations and things that they're doing. If you look at, high grade corporate bonds, of course, their interest rates are going to be very low. Apple is not a junk bond. If I look at Apple's bonds, even in 2020 and so on, look, they're better than the Fed. They get to pay 2% interest. I mean, so if you're buying Apple, yeah, you have safety. They're not high yield. They're not a junk bond. They're high grade. They pay very low interest because their credit worthiness is pristine. So when we're talking junk bonds, we're talking about dangerous situations that companies find themselves in, and then doing that homework to make sure that your investment is going to be a good one. On behalf of Maverick Trading, I'm Corey Halliday. I hope you enjoyed this class on junk bonds, learned a little bit more about how to trade them on the Interactive Brokers Trader Workstation platform. Have a great rest of your day, and we will see you next time. Goodbye, everyone.